Amazon just posted its highest operating margin in history. But behind the scenes, free cash flow has virtually evaporated into thin air. Welcome to Earnings Unscripted. It is April 29th, 2026, and today we are unpacking AMZN's first quarter results.
Yeah, that vanishing act is really the whole story here. You look at the top line and sure, revenue came in at $181.5 billion. That is obviously a big drop from the Q4 holiday peak, but still up 17% year over year. But then you look at what it actually cost to keep that pace. It is a totally different reality.
Right. But before we completely tear their balance sheet apart, just a quick sanity check for the lawyers. This podcast is definitely not financial advice, just our personal opinions and, I guess, occasional spreadsheet-induced hallucinations?
Highly caffeinated hallucinations, mostly.
Fair. But Miro, honestly, the headline profit numbers look bulletproof. I mean, earnings came in at $2.78 a share. That is up massively from $1.95 last quarter, a 43% jump. And they hit a 13.1% operating margin, producing almost $24 billion in operating income.
Right, except that net income number is doing a lot of hiding. It's basically an accounting distortion.
Wait, really? Because of the AI stakes?
Exactly. They booked a $16.8 billion pre-tax gain. Just paper money, literally, from those Anthropic convertible notes shifting to preferred stock. So if you actually strip out that mark-to-market magic, net income drops sequentially.
Okay. That actually explains the bizarre market reaction today, because Amazon was already down over 13% for the actual first quarter. And right after the bell today, it completely plunged. I mean, just an immediate after-hour sell-off.
Sorry, but the sell-off did not last. Once the earnings call started, the tape violently reversed. They actually ended up closing extended hours up about 4% from the regular session.
Because of the cloud narrative. Jassy was very clear. AWS is officially a $150 billion annualized business now. He said they grew 28% year over year, which is the fastest clip in 15 quarters. It's wild to see a business this massive accelerating like a startup again.
The generative AI pull is huge. Customers are practically demanding it. 3 years ago, AWS had an AI run rate of 58 million. Now, it's over 15 billion. So the growth is entirely real. But the physical toll of catching that demand is just staggering.
They are at least getting incredible internal leverage out of it, though. Jassy dropped this great anecdote on the call. They use their own AI agentic tools to rebuild a core service, something that normally takes 50 engineers a full year. 5 guys rebuilt it in 65 days. Just mind-blowing efficiency. Okay, so top line is surging, but you mentioned the physical toll. Let's get into the details on where all this cash actually went.
Yeah, went straight into the ground, literally into dirt, steel, and power contracts. They dropped $44.2 billion on capital expenditures, and that is just for the 3-month quarter alone.
Wow, because Wait, operating cash flow was only $26 billion for the quarter, right? So they are outspending their own cash generation by almost $20 billion.
Correct, which completely nuked their free cash flow. Their trailing 12-month free cash flow fell to just $1.2 billion, which is, look, that is down 95% year over year. Free cash flow has virtually zeroed out on a almost $3 trillion market cap company.
But then how are they bridging that massive of a gap?
Debt. They are physically borrowing money right now to feed the AI machine. They issued over $53 billion in new long-term debt in Q1 alone. So their total long-term debt just doubled. It went from roughly $65 billion at the end of the year to $119 billion now.
That is terrifying. It really is. Taking on that much leverage just to buy server hardware ahead of demand, you are basically just praying the customers actually show up to rent it.
Well, Jassy was pretty blunt about the reality of this infrastructure cycle. He told analysts AWS has to lay out cash for land, power, buildings, chips in advance of when they can actually monetize it. He specifically cited a lag of typically 6 to 24 months before they start billing customers.
Right. The lag is what hurts. You buy the land today, you buy the chips today, Actually, you just reserve the chips today, but you do not see a dime of revenue until 2026 or 2027. It's a massive leap of faith.
Except it's not just buying chips. That's the detail everyone is getting wrong. They're not just writing checks to NVIDIA anymore. This quarter proved AWS is quietly becoming one of the biggest semiconductor companies in the world, all on its own.
Oh, right. The Trainium and Graviton custom silicon.
Yeah, Jassy dropped this incredibly arrogant but totally justified statistic. He said their proprietary custom chips have crossed a 20 billion annualized run rate internally. And he claimed if they spun that division out and sold those chips as a standalone merchant business, their run rate would be $50 billion.
Okay, wait a second. 50 billion? That would put them, easily in the top 3 data center chip businesses globally, just hiding inside AWS.
Pretty much. They are aggressively trying to choke off their dependency on external GPUs, because relying entirely on a third party ruins your margins when the supplier holds all the pricing power. Bringing the silicon in-house is saving them, quote, tens of billions in CapEx compared to buying off the shelf.
Which is a staggering number to even think about. I love the visual of that, though. A shadow $50 billion semiconductor empire just humming in the background. But chips are not the only thing burning a hole in their pocket right now. They are also taking a literal moonshot with Project Kuiper, or Amazon Leo, as they call it now.
Taking on Elon Musk, they are formally acquiring Globalstar to fold direct-to-device spectrum into Leo. And the strategic kicker is they paired it with an agreement to power satellite services for Apple devices. So they want premium real estate on iPhones before Starlink can lock it down.
That is such a classic Amazon play, just bypassing the traditional telco infrastructure entirely. But the upfront cost of getting that off the ground has to be brutal.
It is. The CFO warned they are taking a discrete $1 billion year-over-year cost increase in Q2 just to manufacture and launch more satellites. And none of those launch costs get capitalized until Q4. So it is a pure anchor on their North American operating income next quarter.
Geez. So they're fighting a multi-billion-dollar land grab in space while simultaneously spending tens of billions to build out an entire internal semiconductor ecosystem. Plus, they are retuning the accounting on the hardware they already own.
Ah, yes. The useful life depreciation yo-yo. Good catch.
You taught me to read the footnotes, Miro. So they extended the server life to 6 years last year, but on January 1st, they actually dropped some of them back to 5 years?
Right. So they dialed a subset of servers back down to a 5-year life. Because the pace of AI tech is moving so fast, the hardware is going obsolete quicker than expected. It bumped their depreciation expense by $1.4 billion. It's a hidden tax on their operating margins.
Wow, it just shows you how aggressively this space is cannibalizing itself. So you look at this entire machine, all this new debt, the satellite launches, the custom silicon build-out, and this huge lag in cash flow. How does the market process all of these conflicting signals going into next quarter?
It is going to be incredibly noisy to model. Honestly, they're playing with the timeline here. Management decided to move Prime Day to Q2 this year instead of Q3, so that completely distorts the upcoming revenue picture.
Oh, right, which just pulls an absolute mountain of cash forward into the immediate guidance.
Exactly. Olszewski guided Q2 net sales up to, I think it was somewhere between 194 and 199 billion, which is great. That is roughly 16 to 19% growth. But then you look at the profit guidance. Operating income is actually forecast to drop back down to the 20 to 24 billion range.
Record revenue, but shrinking profits? I mean, where is the leak?
Well, it goes back to the space race we were just talking about. Olszewski actually spelled it out on the call. He said, and this is a quote, "We do expect a year-over-year cost increase of approximately $1 billion related to Amazon Leo as we manufacture and launch more satellites. They are basically eating rocket costs right as revenue peaks."
It is just wild to step back and look at it. I mean, they are carrying a literal space program, a shadow chip empire, and the whole generative AI boom all on the back of retail shipping. It's a massive flex, but it really feels like they are spinning a lot of extremely expensive plates right now.
The math says they can keep spinning them. Look, the debt load is objectively heavy, but they still have the underlying core growth. The real test is just how long Wall Street tolerates essentially zero free cash flow while waiting for all this hardware to start paying rent.
Yeah, that is the trillion-dollar question right there. We will see if the patience holds until those data centers actually start billing customers. But for now, we should probably wrap this up.
I think so. Let the spreadsheets cool off a bit.
Absolutely. Thanks for unpacking it all with me, Miro, and thanks everyone for listening. We'll catch you next time. If you want these breakdowns to just show up in your feed, the easiest way is to simply follow the podcast. Just a quick aside, Earnings Unscripted is generated with the help of AI tools, mostly to explore if we can take heavy market data and actually make it feel like a natural human conversation. We genuinely love to hear your thoughts. So if you have feedback or a ticker request, just shoot an email to earningsunscripted@datamadness.ca or find the X link in the show notes.
Catch you next time.